Welcome to the Pro Ticker Deep Dive.
It's good to be here.
It is the first week of February 2026. And, I want to start by trying to capture the specific texture of this moment, the feeling in the tech economy right now.
It's a totally different world than it was just a short time ago.
It really is. I mean, if you just close your eyes and rewind, say, 2 years, go back to early 2024 or even late 2023, the energy was, well, it was frantic.
It was a casino. Absolutely. A speculative mania.
A total casino. You had startups, raising $50 million on basically a PDF and a .ai domain name.
Sure.
That was a real thing.
Oh, yeah. We were deep in the discovery phase. Everybody knew something massive was happening with AI, but nobody knew exactly what the form factor would be, so the strategy was just throw money at everything that looked like a neural net.
I remember hearing about procurement managers at big companies buying pallets of H100 GPUs and just leaving them in the boxes.
Because they didn't even know how to rack them yet. They just knew they had to have them. It was a gold rush in the most chaotic sense of the word. Fear of missing out on a global scale.
Right. But looking at the numbers we have on the desk today, and we're talking about the hard financial data for the fiscal year ahead, the vibe has completely, and I mean completely shifted.
The party's over.
The party is over. The music has stopped, the confetti's being swept up, and you can hear the rumble of heavy trucks outside. The construction crews have arrived.
That's the perfect metaphor. We are not in a gold rush anymore. We have entered the era of industrialization.
Industrialization. I think that's the exact framework we need to use.
It has to be. I mean, this isn't tech in the way you and I might have thought about it in, say, 2010 or even 2020. This isn't about a couple of kids in a dorm room who can disrupt an entire industry with just a laptop and a clever idea.
That story is over for now.
It has morphed into heavy industry. When you look at the capital requirements, the sheer scale of the investment, we're talking about concrete. We're talking about steel, gigawatts of power, specialized silicon, advanced liquid cooling.
The physical world.
We are moving from the software phase of AI, which was that gold rush, to the infrastructure phase. And that's a much more brutal, expensive game.
Okay, so to set the stakes for this whole deep dive, I want to anchor us on one single number. If you, our listener, take away one thing from this conversation today, it should be this figure, because it defines the entire macro environment for 2026.
It's a staggering number.
$602 billion.
Yeah. It's a number so large that it almost loses its meaning unless you really try to contextualize it. It's just a sound.
So let's try to put that in perspective.
Yeah.
That is the projected capital expenditure, that's CapEx, for just the top 5 technology companies in the world.
Just 5 companies.
For this calendar year. $602 billion. To give you some scale, that is significantly higher than the entire gross domestic product of countries like Belgium or Sweden or Argentina.
So you're saying 5 corporate boards, just a handful of people in a few rooms, are going to spend the entire economic output of a mid-sized European nation.
In a single 12-month period.
And, the velocity of that growth is what's really terrifying to some of the analysts I've been reading. I mean, that $602 billion figure, that's a 36% increase over 2025.
Which was already a record.
A massive record-breaking year. Everybody thought spending had peaked in 25. The consensus was, okay, they bought their initial GPU cluster, now they'll slow down and digest it.
And the opposite happened.
The absolute opposite. They are accelerating into the curve.
So our mission for this deep dive is, well, it's to follow that money. We need to unpack specifically where $602 billion is going.
Where does it flow?
We also need to understand why these companies, who, historically sat on these huge cash piles like dragons on a hoard of gold, why are they suddenly taking on massive amounts of debt to fund this?
Which is a fundamental shift in their business model.
And finally, we've got to get into the weeds. We have to talk about the brutal 3-way war for the silicon that is soaking up the vast majority of that cash.
And war is not hyperbole here. I think that's important to state. The competitive landscape for 2026 has shifted so aggressively. The monopoly days are showing some serious cracks.
Okay, let's start there. Let's start with the big 5. When we talk about this incredible level of spending, who exactly are we referring to?
We're talking about the hyperscalers, the companies that own the massive cloud infrastructure. So that's Amazon, Microsoft, Google, Meta, and Oracle.
Oracle being included in that big 5 bracket is, I think, really interesting in itself, and we should definitely circle back at them. But if we look at the breakdown...
Yeah, the individual numbers are just as wild.
Amazon, Microsoft, Google, and Meta. They are each expected to exceed $100 billion in individual CapEx this year.
$100 billion each.
Each.
pause and think about that threshold for a second. $100 billion. Historically, the only entities on planet Earth that spent that kind of capital on physical infrastructure were like oil supermajors building offshore platforms.
Or governments.
Or governments fighting a war or building a national highway system. For a company that, on paper, sells software and services, spending $100 billion a year on physical gear is a complete rewriting of what that business even is.
And it's not just general cloud spending, is it? I think that's a key distinction. A lot of people might see the word CapEx and assume, oh, Amazon is just building more warehouses for Prime.
Right, or Google is just replacing some old servers for Gmail, the usual maintenance stuff.
But the data we're looking at, it really distinguishes between that traditional spending and this new wave.
It does. There's a very distinct AI tax on this spending. And the numbers are clear. Roughly 75% of that $602 billion, so let's call it $450 billion, is specifically allocated for AI infrastructure.
$450 billion.
That money is flowing directly into the accelerated computing stack. We're talking advanced GPUs, custom silicon, the liquid cooling systems you need to run them without melting the building, and the reinforced data center shells to house it all.
So this is not for storing your photos.
No, this is not for standard web hosting. This is purely for the AI compute layer. It's a brand new category of spending that didn't really exist at this scale 4 years ago.
So 3/4 of this unprecedented spending is a direct bet on AI. But here's the part of the analysis that I found most jarring, the part that really signals a paradigm shift.
With financing.
The financing. Historically, big tech companies were the safe stocks, right? They were these cash printing machines. They had free cash flow that was just off the charts.
They funded everything internally. They didn't need banks. They didn't need Wall Street. They were their own bank.
Exactly.
Yeah.
But looking at the balance sheet projections for 2026, that entire era is dead. It's over.
It has been completely inverted. What we're witnessing right now is a massive debt wave.
A debt wave.
In 2025 alone, these 5 companies collectively raised $108 billion in debt. That was the first major signal. But the projections we're seeing now suggest they are on track to issue upwards of $1.5 trillion in new debt over the next few years.
Okay, we have to pause on that. $1.5 trillion in debt. Why? I mean, Microsoft and Google and Amazon have immense revenue. They're incredibly profitable. Why do they need to go out and borrow money like a distressed retailer or a startup?
It's because the CapEx is now outpacing their free cash flow. It's a simple, brutal math problem.
So even with all the money they make, it's not enough.
It's not enough. Look, even if you were making, say, $80 billion a year in pure profit, which is an incredible amount of money, if you suddenly decide you need to spend $120 billion on new factories, and that's effectively what these AI data centers are.
Right, they're factories for intelligence.
You have a $40 billion hole in your budget. It's that simple. So you have a choice. You can either sell your own stock to raise the cash, which dilutes your existing shareholders and almost always tanks your stock price. Or you can go to the bond market, where interest rates are still relatively manageable, and borrow against your future earnings. And given the choice, they are all choosing debt.
This brings us to a metric that I think is critical for our listeners to really understand. The term is capital intensity. I saw this flashing red in all the analyst reports. Can you just explain what this measures and why the current numbers are so freakish?
Yeah, capital intensity is it's a pretty straightforward concept. It's simply the percentage of your total revenue that you have to immediately turn around and spend on physical infrastructure just to keep the business growing.
So how much of every dollar you make has to go right back into buying more stuff?
Exactly. And for a software company, the ideal number is very, very low, maybe 5%, 10% at most. The whole beauty of the software model was you write the code once, you put it on a server, and you can sell it 1 billion times with very little marginal cost.
That's why tech stocks had such high multiples for so long. They were capital efficient.
Supremely capital efficient. But that's not the world we're in anymore.
So where are we now? What are the capital intensity numbers for the hyperscalers in 2026?
We're in a completely different universe. We're looking at capital intensity levels between 45% and 57%.
45 to 57%.
Oracle specifically is projected to hit 57% in 2026.
Wow. But that sink in for a moment. For every single dollar that Oracle collects from a customer, 57 cents of it goes immediately out the door to buy more chips and pour more concrete.
It fundamentally changes the financial profile of the company. It puts them in the same category as like a utility company.
What?
Or heavy manufacturing. If you look at the balance sheet of a company running coal power plants or building railroads back in the 19th century, this is what it looked like.
High debt, massive physical assets on the books.
High depreciation, which we have to talk about.
Yeah.
These are no longer software companies in the traditional high-margin sense of the word. They are becoming infrastructure utilities.
The analogy that came to my mind, and tell me if this tracks, it's like you have a very wealthy homeowner.
Yeah.
They live in this pristine, paid-off mansion. They have tons of cash.
Okay.
But suddenly, they become convinced that the future isn't living in the mansion, it's manufacturing widgets.
Yeah.
So they decide to build a massive high-tech factory in their backyard.
Right next to the pool.
Right next to the pool.
Yeah.
But this factory is so state-of-the-art, so expensive, that it actually costs more than the mansion itself. So despite being wealthy on paper, they have to go to the bank and take out a massive second mortgage just to pour the concrete. They're betting everything that this factory will eventually pay off, and pay off big.
That's a solid analogy. It really is. But I would add one caveat that makes the real-world situation even riskier.
With
In your analogy, a factory usually produces a widget you can sell. A car, a toaster, something with a known price. These companies, they're building factories for compute, for intelligence. They are betting that the demand for token generation will be effectively infinite.
Right. They're building the factory before they're 100% sure what the final product's market price is.
They're building capacity based on speculation of future demand, not just on confirmed orders from today. And that is the multi-trillion-dollar gamble. If we build it, they will come.
Let's look at they're building that. They're buying silicon. And for the last, 3 years, buying silicon was basically synonymous with writing a very large check to Jensen Huang and NVIDIA.
NVIDIA has been the market hegemon. There's really no other word for it. They weren't just the leader in the market. For a while, they were the market.
The numbers still show them with, depending on the report, 80 to 90% market share in the data center. Their Blackwell architecture is still, technically the performance king for many tasks.
It's a beast of a chip.
And they have the moat, the thing everyone talks about, CUD.
The software lock-in. It's been their trump card for over a decade.
Right. For years, the argument against any competitor was, look, it doesn't matter if you make a faster chip because all the world's AI developers are coding in CUDA. If a company switches to your chip, they have to rewrite all their code.
And that's a nightmare. NVIDIA spent 20 years digging this deep, wide trench around their castle, and they filled it with proprietary libraries and software tools that developers were, frankly, terrified to leave.
It was the walled garden strategy, and you have to admit, it was brilliant.
Absolutely brilliant. It created a situation where the switching cost for their customers was higher than the potential hardware savings. Even if a competitor's chip was, say, half the price, the engineering time and the risk involved in migrating your entire software stack just wasn't worth it.
But, market dynamics, they hate a vacuum. And they absolutely hate a monopoly charging 75% gross margins. Looking at the stock market performance in 2025, it really seems like the market believes that armor is starting to crack.
The signal from 2025 was incredibly clear, and I think it shocked a lot of people. AMD stock actually outperformed NVIDIA.
By a lot.
By a huge margin. AMD was up 82%, while NVIDIA was up only 34%. Now, to be clear, NVIDIA is still a much larger company by market cap, of course, but the momentum, the narrative, it's shifted. Investors are placing serious bets that the monopoly is ending.
So why? What changed? Is this just, pity money for the underdog? Are people just buying AMD because they're desperate for a second option, or is the technology actually competitive now?
Oh, it's genuinely competitive.
Yeah.
And in some specific and increasingly important workloads, it's actually superior. 2026 is shaping up to be the year of the duopoly. It's no longer a one-horse race.
Okay, so let's get technical. What is AMD actually doing that is starting to hurt NVIDIA? Because for a long time, let's be honest, AMD was seen as the value brand. You bought it because you couldn't get your hands on enough H100s.
Right. They were the alternative, not the first choice. That's changed. And it comes down to a specific architectural bet that AMD made years ago, which is now paying off in a huge way.
And what's that?
Memory density.
Memory.
Specifically, high bandwidth memory, or HBM. If you look at the spec sheets for AMD's Instinct line of chips, the MI300X and the newer MI325X, they are absolute monsters when it comes to on-chip memory capacity.
I'll give you the numbers.
Okay, so the MI300X, which is out there now, it packs 192 gigabytes of HBM3. which is a lot. But the newer MI325X coming soon pushes that to an incredible 288 gigabytes.
Okay, we need to explain why that matters. To a layperson, more gigabytes just sounds like a bigger hard drive on your laptop. Why does having 288 gigabytes of memory sitting right on the chip itself change the economics for a company like Meta or Microsoft?
It changes everything because of how these large language models actually work. These models, GPT-4, Llama 3, Claude, all of them, they are massive. They consist of hundreds of billions, sometimes trillions of parameters. That data, all those parameters, has to live somewhere to be processed.
It has to be loaded into memory to run.
Exactly. And ideally, for the fastest possible performance, you want the entire model to live on the chip's own ultra-fast memory right next to the compute cores. If the model is too big to fit on one chip's memory,
You have to split it up.
you have to split it across multiple chips. Maybe 2, maybe 4, maybe 8.
And that introduces latency, right?
Yeah.
A delay.
Massive latency. And cost. Think about it. If you have to use 8 NVIDIA chips to hold a single instance of a large model because each chip has less memory, you are paying for 8 chips. You're paying for the power for 8 chips, the networking for 8 chips.
Okay.
But if AMD's chip allows you to hold that exact same model on just 4 chips because they have double the memory density, you have instantly cut your hardware requirement, your power draw, and your physical footprint in half for that task.
And you've also eliminated the traffic jam of moving all that data between the chips.
That's the key. You dramatically reduce the chip-to-chip communication overhead, which is a huge bottleneck, and this directly impacts the cost of inference.
Okay, let's double-click on that word, inference. Because all the analysis we've seen suggests we are at a major inference inflection point right now.
This is the single most critical pivot in the entire industry for 2026.
So for the last 2 years, all the headlines were about training.
Right. Training is the process of creating the brain. You feed a model the entire internet, you run it on a supercomputer for 3 months, you burn $1 billion worth of electricity, and out the other side pops a trained model like GPT-4.
And that requires just raw, brute force computational power.
Brute force floating point operations.
Oh.
And NVIDIA is still, and will likely remain for a while, the king of training. Their architecture is built for it.
But inference is using the brain.
Inference is what happens every single time you type a query into ChatGPT or ask a coding assistant for help. The model is already trained, it's frozen, it's just calculating the answer for you. And 2026 is the year where the aggregate cost of inference, the daily operation of these models for billions of users worldwide, has finally and definitively surpassed the cost of training them in the first place.
So it now costs more to run the car day to day than it did to build the entire car factory.
By orders of magnitude. And when your business is inference, you care about 2 things above all else. Throughput, which is how many users you can serve at once, and cost per token, which is how cheaply you can generate an answer.
And this is where AMD's memory advantage really shines.
It's their killer app. If you can serve more users with fewer chips because of that memory density, your margins improve significantly.
So, to use an analogy, NVIDIA is kind of like the Formula One car. You use it to set the fastest possible lap time once that's training. But AMD is positioning itself as the heavy-duty semi-truck you use to actually haul all the freight day in and day out as efficiently as possible.
That is a much, much better way to view the emerging duopoly. And the hyperscalers, they absolutely get this. We are now seeing Microsoft, Meta, Oracle, and even OpenAI publicly talking about deploying AMD chips in production.
This isn't just a quiet little trial anymore.
No, this is public. They are mixing them into their production stacks. The takeaway is, it's no longer an NVIDIA-only shop in the cloud. That era is over.
And AMD is pressing their advantage. The roadmap shows the MI350 series is coming later this year, and they've already teased the MI500 for 2027. They smell blood in the water.
They absolutely do, but here's the thing. They aren't the only threat to NVIDIA. In fact, the biggest long-term threat to NVIDIA might actually be NVIDIA's own best customers.
You're talking about the homegrown silicon, the custom chips.
Exactly. Amazon, Google, Microsoft. They are all terrified of being dependent on a single supplier who charges a 75% gross margin for a critical component. So they want to vertically integrate. They want to own the entire silicon stack, just like Apple decided it needed to own the silicon in the iPhone.
Let's look at Microsoft's efforts here, because the reports highlight 2 of their internal chips, Maya and Braga.
Right, so Maya is their heavy lifter, designed specifically for AI acceleration, but Braga is the one that seems to be causing them some headaches right now.
Okay, what's the story with Braga?
It's a classic tale of hardware reality hitting software ambitions. I think software companies often underestimate just how hard physics is.
Building chips is not the same as shipping an app update.
Not at all. The reports we're seeing indicate that Braga production has been delayed into the latter half of 2026, and more worryingly for them, the initial benchmarks suggest it might fall short of NVIDIA's performance per watt.
So they're trying to divorce NVIDIA, but they can't quite get the paperwork signed because their own alternative product isn't quite ready for prime time.
It just proves that NVIDIA's lead isn't just marketing hype. It is genuinely difficult to design and manufacture a world-class GPU. You can't just throw an infinite amount of cash at the problem and expect to beat a company that has been obsessively optimizing silicon lithography for 30 years.
But a company like Microsoft doesn't give up easily. And they aren't doing this in a vacuum, are they? They're leaning on partners to help them design these custom chips.
Right, which brings up these silent winners that the reports were highlighting. Companies like Broadcom and Marvell.
If you're looking for the companies that are, selling the pickaxes in the gold rush, or maybe more accurately, selling the rivets in this industrialization phase, it's Broadcom.
Broadcom's name just kept showing up in every single financial statement and supply chain analysis I looked at.
Broadcom is effectively the arms dealer for the custom silicon world.
Mm-hmm.
They aren't trying to build their own big brand GPU. Instead, they have this incredible portfolio of intellectual property for all the boring but essential stuff.
The plumbing.
Moving data around a chip efficiently. So when Google or Meta or even OpenAI decides they want to build their own chip, they don't start from scratch. They go to Broadcom and say, help us put this together. Broadcom is expecting massive AI-related revenue growth in 2026 because they are the key enabler for everyone else's independence from NVIDIA. I saw a specific note that Broadcom is helping create OpenAI's first custom chips, which are slated to arrive late this year.
That is a huge development. I mean, Sam Altman has been extremely vocal about the scarcity of compute being his #1 bottleneck. He doesn't want to rely on Microsoft's cloud or NVIDIA's supply chain forever. He wants OpenAI to control its own destiny.
And Broadcom is the company that's enabling that strategy.
They're the key partner.
So you have this incredibly chaotic battlefield shaping up. You got the incumbent, NVIDIA, still the king, but under pressure.
Yeah.
You have the direct challenger, AMD, flanking them on memory and inference. And then you have the customers themselves, the big five, trying to build their own weapons with the help of these mercenary design firms like Broadcom.
It's all a battle for margin. That is what this really comes down to. If you own the silicon, you control your cost structure. If you are forced to rent the silicon from Jensen Huang, he controls your cost structure. And when you're spending $600 billion a year, even a 10% efficiency gain is worth tens of billions of dollars.
There is another dimension to this whole inference story that I think is important. It's the one that moves us away from these massive centralized data centers. I'm talking about edge AI.
The edge.
Not the guitarist from YouTube for our listeners.
Yeah.
We're talking about putting AI processing where the data is actually born.
Right, out in the world, on satellites, on factory floors, inside automobiles, in medical devices.
Why is this a separate market, though? Why can't we just stream all that data back to the cloud and process it there?
2 reasons: physics and privacy. The physics part is latency. If you are a self-driving car, you cannot afford to wait 200 milliseconds to send a video frame to a data center in Virginia to ask, is that a pedestrian crossing the road? And then wait for the answer to come back.
The decision has to be instant.
It has to happen on the car, in microseconds. And second, you can't exactly put an NVIDIA H100 server rack in the trunk of a Tesla. It requires way too much power and generates a crazy amount of heat.
You need a different class of chip.
Exactly. You need highly efficient, low-power inference chips that are optimized for specific tasks. And this is where companies like Marvell are seeing a lot of growth and where the whole custom silicon fight expands. It's not just about building the biggest brain anymore. It's about building the most efficient brain for the point of action.
Now, speaking of points of action, we cannot have a serious discussion about the semiconductor supply chain without zooming out to the geopolitical map. Because in January of 2026, the rules of the game changed yet again.
The government has, I think, effectively decided that these advanced chips are not just commercial products anymore. They are instruments of national power.
So the Trump administration codified some new policies back in January. Let's walk through the tariff first.
Yeah.
This is a new 25% tariff on advanced AI chips that are not destined for the U.S. supply chain.
This is what you'd call a reshoring mandate with some serious teeth. The administration is looking at the global map and saying, We are not comfortable with the fact that 90% of advanced chip packaging happens in Asia, particularly Taiwan. So they're using a very blunt instrument to force change.
The message is, if you want to sell your best tech here, or if you want to use the U.S. financial system, you need to start bringing that manufacturing capacity back to North America.
Or at least allied nations.
But here's where it gets really complicated and almost contradictory. At the same time they are slapping on these tariffs, the Department of Commerce made a very nuanced rule change regarding exports to China. They're calling it the case-by-case rule.
Right, and this is where the strategy gets really interesting and frankly very tricky. Previously, for the really high-end stuff, we're talking the H200 or the top-tier AMD chips, there was a presumption of denial for any exports to China.
Meaning the default answer was just no.
The default was no, you can't sell it. Now the policy has shifted to case-by-case.
That sounds like a softening of the stance. Why would a famously hawkish administration soften the rules on exporting high-tech to China?
Well, it isn't necessarily a softening so much as a recognition of a very difficult economic reality. The U.S. chip companies, NVIDIA, AMD, Intel, they have been screaming to policymakers that if they are locked out of the Chinese market entirely, they lose something like 30% of their global revenue overnight.
And their argument is, if they lose that revenue.
If they lose that revenue, they can't afford the massive R&D budgets they need to stay ahead of China in the long run. So it's catch-22.
So the strategy is, let us sell them the second-best chips so that we can fund the development of the absolute best chips, which we'll keep for ourselves.
That's it exactly. It's trying to thread an incredibly fine needle. You want to extract capital from the Chinese market by selling them powerful but not too powerful chips, while restricting the performance just enough so they can't use them to build frontier AI models that could threaten U.S. national security.
It seems like a very, very difficult line to walk. It's like saying, we'll take your money, but we're not going to give you the best gun in the shop.
And of course, China knows this. They are not sitting still. This entire policy of restriction is just pouring gasoline on the fire of a concept they call sovereign AI.
Sovereign AI. I've seen this term popping up everywhere in the briefing papers recently. It sounds like something from a cyberpunk novel, but it's actually becoming a massive revenue driver for the chip makers right now.
It is. It's probably the biggest new growth area outside of the U.S. hyperscalers. It's the realization by mid-sized global powers, the UK, India, Japan, the UAE, Saudi Arabia, that they cannot afford to become digital colonies of the United States.
What do you mean by that, a digital colony?
It means they don't want their national healthcare data, their sovereign financial records, or their citizens' personal conversations and data running on a server that is owned by an American company and physically located in Virginia, subject to U.S. laws.
They view AI infrastructure as critical national infrastructure.
Like an electrical grid or a water treatment plant or an army, they are saying we need to own this ourselves.
So they're going out and buying their own massive clusters of GPUs.
They are writing enormous checks. We are seeing deals where sovereign wealth funds are buying tens of thousands of GPUs at a time to build state-owned national data centers inside their own borders. They want the AI factory on their own soil running under their own laws.
This helps explain why the demand for these chips isn't softening, even with the high prices. Because even if Amazon slows down its purchasing for a quarter, the Kingdom of Saudi Arabia speeds up.
It diversifies the customer base, yes, which is good for the chip makers. But it also puts terrifying, almost unbearable pressure on the global supply chain because all of these powerful actors, the hyperscalers, the startups, the sovereign nations, they all have to funnel their orders through a single tiny choke point.
TSMC.
Taiwan's semiconductor manufacturing company, the foundry. The place where all the magic actually happens.
The reports we've seen say TSMC needs to effectively double its production of these advanced chips to meet all this new demand. Is that even physically possible? I mean, you can't just 3D print a semiconductor fab overnight.
No, you absolutely can't. A new leading-edge fab takes 3 to 4 years to build and calibrate and costs upwards of $20 billion. But there's another bottleneck in this system that's even tighter than the foundry capacity right now.
And what's that?
It's HBM, that high bandwidth memory we talked about earlier with AMD.
Right. You can print the perfect GPU core, but if you don't have the memory stack to glue on top of it, The chip is basically a useless piece of silicon.
It's a doorstop. And this is where the corporate warfare gets really interesting over in Asia. SK Hynix, the South Korean company, has effectively won this round of the memory wars. They managed to capture about 2/3 of NVIDIA's orders for the next-gen Blackwell chips because their HBM yield and performance was just better.
Where is Samsung in all this? They're usually the 800-pound gorilla in the memory market.
Samsung stumbled. They apparently missed a key technical shift on HBM packaging and thermal compression early on, and now they are desperately playing catch-up. It's a stark reminder that in the hardware business, if you miss one technology cycle, it can take you 3 years to recover. You can't just patch a factory line.
So let's just take a moment and look at the whole board. We have a supply chain that is stretched to its absolute limit. We have geopolitical friction with tariffs and export controls creating uncertainty. And we have a $602 billion spending spree being funded by a mountain of new debt.
Yeah.
This whole situation feels very fragile.
It has immense structural risk baked into it. The whole system is running incredibly hot.
Let's talk about that downside. Let's talk about the risks. The reports we read kept mentioning a phrase, depreciation drag. Now, this sounds like a boring accountant's problem, but it seems to be an existential threat to the stock prices of these huge companies.
It is the single biggest financial risk to big tech right now, without a doubt.
So explain it for us. We're spending $600 billion this year on new gear. Are we making $600 billion back from that gear?
Not yet, not even close. And the problem is the clock is ticking loudly because of depreciation.
Okay, use an analogy for us here. This isn't like buying a piece of land, right? It doesn't hold its value.
No, it's the opposite of buying land. If you buy a plot of land or an office building, that asset holds its value for 30, 50, even 100 years. It depreciates very, very slowly. Or think about an airline. If Delta buys a new Boeing jet for $100 million, they can fly that jet for 20, maybe 25 years. They have 2 decades to pay off the loan and make a profit.
Right, a long time horizon.
An NVIDIA H100 GPU or an AMD MI300X, its peak economic lifespan is maybe 4 years, maybe 3. By year 4, it is so much less efficient compared to the new chips on the market that it's effectively e-waste. It burns too much power for the amount of compute it provides.
So these companies are spending $600 billion a year on assets that essentially rot like fruit on the vine.
That's a great way to put it. They are buying an asset that loses, say, 25% of its value every single year. That accounting charge hits their income statement. And it means you have to generate massive amounts of new cash flow immediately to justify the purchase. You can't wait 10 years for the ROI to show up. The asset will be worthless by then.
And this brings us to what the analysts are calling the software monetization gap. We've built the superhighways, but we haven't built enough toll booths yet.
We have ChatGPT, we have Copilot for developers, we have coding assistants, image generators, and they are generating real revenue for sure. But the question is, are they generating enough profit to cover a $600 billion annual hardware bill plus the interest on $1 trillion of debt?
The math doesn't close yet.
Right now, today, the math doesn't close, and that's the scary part.
So we could genuinely see a scenario in 2026 where these companies, like Microsoft or Google, grow their top-line revenue, they sell more stuff, but their earnings, their actual take-home profit, could drop.
It could absolutely drop because the depreciation cost of all this new gear is a massive anchor that's dragging down their bottom line, and that is the profitless growth scenario that gives Wall Street nightmares.
And this leads directly to the fear of ghost cities. The idea that we are overbuilding, that we're just repeating the fiber optic cable boom of the year 2000 all over again, building way too much capacity before the demand is actually there.
It's a very valid fear. Are we building these gleaming billion-dollar data centers that are going to sit 40% empty in 2027 because the killer apps didn't materialize as quickly as we hoped?
Is that happening right now? Are there empty racks?
The data we have says no. Exactly. The market isn't worried about today. It's worried about 18 months from now. If the killer app for AI doesn't emerge, and I don't mean a better chatbot, I mean something that fundamentally revolutionizes biology or drug discovery or logistics to the tune of trillions of dollars in new economic value, then who is going to pay for the next round of chips in 2027 and 2028?
We have covered an immense amount of ground here. I mean, from the corporate balance sheets to the architecture of the silicon itself, all the way to geopolitical maneuvering. I want to try to synthesize all of this for the listener. What is the main signal we should take away from all this noise?
I think the signal is that the second wave of this AI revolution is here. The first wave was the consumer hype. It was the chatbots, the image generators. That was fun. It was novel. But the second wave is structural. It is about industrial infrastructure.
It's the move from the flashy showroom to the noisy factory floor. It's the utilities.
It is the utilities. And the winners in 2026 aren't necessarily going to be the companies with the coolest new iPhone app. They are going to be the ones building the grid. The chip designers like AMD and NVIDIA who are providing the engines, the connectivity players like Broadcom who are building the railroad tracks, and increasingly, the sovereign nations who are securing their own energy and data independence for the century ahead.
It feels less like we're watching a tech trend unfold and more like we are watching a form of nation building or maybe even planet building.
It absolutely is. We are in real time rewiring the cognitive layer of the global economy. And that process is messy, it's expensive, and it's incredibly dangerous.
So as we wrap up this deep dive, I want to leave you, our listener, with a final thought, a provocation really to think about. We are currently witnessing the single largest transfer of wealth into physical assets, into chips, into energy infrastructure, into data centers in the entire history of the technology sector.
And critically, it's being funded by the largest debt issuance in the history of the sector. We are leveraging the future to build the present.
If that software monetization layer that we talked about doesn't catch up, if we don't find the truly transformative use cases that generate the trillions in value needed to pay for all this infrastructure by, say, 2027 or 2028, then we are not looking at a simple tech bubble bursting. A bubble bursting is just paper wealth, stock prices vanishing into thin air.
This is different. This is physical. These are real assets.
We would be looking at a utility crisis. We would be looking at the world's most valuable and important companies holding trillions of dollars in rapidly depreciating silicon. That is, for all intents and purposes, turning into very expensive space heaters.
It is, without a doubt, the highest stakes poker game ever played in business history.
So the question you have to ask yourself as an investor or even just as an observer of the world is this. Are they building the railroads of the future that will power the next century of global commerce? Or are they building the empty, gleaming ghost cities of the past?
Only time in the next few quarterly earnings calls will tell.
That's it for this week's Pro Ticker Deep Dive. We'll see you in the next one.